Okay. I need to see if this is working now. My computer is at least letting me do stuff. What is going on, YouTube? Not that one. Sounded fine in that. Hold on. Go to my live. My computer is at least letting me do stuff. Okay, yeah, it's working fine now. Before, my computer just took a shit. Like, to put it lightly, my computer just crapped itself. I don't know. But we'll see if people get back in here. Yeah, that was ugly. I knew though, one, I don't know how my mic got unplugged, but two, my computer just crapped itself. And it had to, you know what? My dog had to have unplugged it. And I'm not even making up stuff. My dog's right under me. He's been going in circles around me. But if you go to my last live, my volume was normal. So the volume messed up when my dog decided to do something by walking everywhere around me. So I apologize. We're back. It should be working fine for anybody who ends up getting in here. We have 9 minutes until this thing goes live. And now I got people probably trolling me on X right now. I already think they started, to be honest. I already know I got people trolling me on X right now. So, I mean, it's all laughs. It's all jokes. So that sucks. We had 300 people in here, and my mic took a crap. So, I'm going to go back through the numbers, get back in this at 5. If people join, that's chill. If I end up being in here by myself now, that's also chill. There you go. Okay. Legal contingencies, 40 stat. So people were talking about the legal contingencies. So yes, they did do this like stupid. They put like loss, and they put the loss down here. These are the losses. Or maybe I'm dumb, because this is also it's interest expense. Benefit from provision for income taxes. Yeah, no, something's wrong with this. Adjusted EBITDA looks good. Net cash used in provided operating activities. Okay. We have the earnings call in 7 minutes. I'm gonna. I want to see. I know Him's House has been putting out a lot of good stuff, so I want to see what he's been posting about. I know he's been putting out stuff about peptides and just like whatever they release. So Hims Q2 earnings, yeah, we know this. Gross margin 64%. And then yep, subscribers were up. Just the EBITDA is going up. Cool. Hims included Eucalyptus subscribers in its subscriber count. Okay. That we did not know. So a major part of the reason subscriber net adds was plus 12% quarter-over-quarter in Q2. Growth in subscribers was primarily driven by increased traffic to our platform, as well as by our recent acquisition. I want to know why they include Eucalyptus but not the other platforms. That doesn't make sense to me. offering, yeah, we figured they'd say that. Hims signed a deal worth up to $30 million for peptide API manufacturing, not an acquisition of a company. This is a tech expertise transfer, so Hims can make certain peptide APIs in-house. That's really good to see. In July 2026, the company entered into a one-time agreement with the company in the peptide manufacturing industry to obtain the expertise and technology necessary for the company. So this is just another example of how Hims is building everything inside out and building the infrastructure, and these other companies are not doing that. Plain and simple. At the beginning of 2026, guidance was 2.8 billion revenue. Now the current guide is 3.2 billion. But most, I guess, 200 million of that can be considered eucalyptus. About 250 million of that can be considered eucalyptus. We know about the gross margins. We know about the subscriber count. Yeah, that is good. And also, I'm glad to see you back, Alexandra. I'm sorry about the mic. It turns out I think what messed it up was my dog unplugged the mic. My dog's been going in circles around me, and I think that's how it got unplugged, because I don't know how else it would have got unplugged. And then 2, my computer took a crap, and that's why it wouldn't let me end stream, so I had to turn off my PC. So, I apologize for that stuff happening. I will have to make sure that doesn't happen in the future. So Yemi said our second quarter results were defined by a significant reacceleration in our growth profile and the continued expanding reach of our platform. Domestic revenue growth and our international business grew more than 17-fold. We expect our domestic business to continue accelerating through the second half of the year. Something I want to look at, so they did, let me go back to the presentation. International did, how much in revenue again? That's crazy. Next, Q3. See, I don't get that. How are they going to do 880 to 900 million in Q3, but guide for 3.1 billion to 3.3 billion? Like, does that math? Or are they being conservative? Because they did 608, and then what was it, 502? I mean, not 502, 752? If not, it was still around there, so I'm just going to go with that. And then if they do 890, I messed up. 608 plus 752 plus 890. That puts you at 2.25 billion. And then in the next quarter, what? It's only going to get better. There's just no way. You do, I guess, yeah, you kind of have to do like a billion. Because if you did a billion, that'd put you at 325. So yeah, no, I guess that guide is about right. Assuming they don't hit the high end of here and then adjust again. So, okay. The call should be starting in 2 minutes. 2 minutes. There was something else I wanted to look at. Oh, I wanted to look at international again. So 131 minus the like 752 was. So they did about 621 organic, and last quarter it was like mid 500s if I remember right. So I was curious on what the organic did, but the organic did pretty well. It was under my number though. Well, I guess that's U.S. business. My original organic number still included international, so that's, I can't look at it that way. So yeah, not bad, not bad. the more I hear about the quarter, the better. But at the same time, I don't want to. I don't know. Sometimes I'm a little iffy about letting commentary from management sway how I felt when I originally saw the results. The context is also important. Because I was also confused. Usually when you see parentheses, it doesn't mean it means a negative. So when I'm looking at this and I see legal contingencies, I see 47,500. I'm thinking that's a hit. You know? And someone did say it hit EPS, so I think that is supposed to be hit. But I don't know why, it doesn't look like it's negative. Anyways, the call is starting. Let me join it.
Hello, everyone. Thank you for joining us and welcome to the Hims & Hers Health second quarter 2026 earnings call. After today's prepared remarks, we will host a question and answer session. If you would like to ask a question, please press *1 to raise your hand. To withdraw your question, press *1 again. I will now hand the conference over to Bill Newby, Director of Investor Relations. Bill, please go ahead.
Good afternoon, everyone, and welcome to the Hims & Hers Health second quarter 2026 earnings call. On the call with me today is Andrew Dudum, our co-founder and Chief Executive Officer, Yemi Okupe, our Chief Financial Officer, and Mo Elshenawy, our Chief Technology Officer. Before I hand it over to Andrew, I need to remind you of legal safe harbor and cautionary declarations. Certain statements and projections of future results made in this presentation constitute forward-looking statements that are based on, among other things, our current market, competitors, and regulatory expectations, and are subject to risks and uncertainties that could cause actual results to vary materially. We take no obligation to update publicly any forward-looking statement after this call, whether as a result of new information, future events, changes in assumptions, or otherwise. The risks, uncertainties, and other factors that could cause actual results to differ from our forward-looking statements are described in our earnings release and SEC filings. Please see our recent earnings release and most recently filed 10-K and 10-Q reports for a discussion of these risk factors as they relate to forward-looking statements. In today's presentation, we also have certain non-GAAP financial measures. We refer you to the reconciliation tables to the most directly comparable GAAP financial measures contained in today's press release. You can find this information as well as a link to today's webcast at investors.hims.com. After the call, this webcast will be archived on the website for 12 months. And with that, I will turn the call over to Andrew.
Thanks, Bill. Good afternoon, everyone, and thank you for being here. This quarter, we made significant progress on building a first-of-its-kind health experience that proves it is possible to deliver access to world-class care on a global scale at a reasonable price. As our customer base grows and our influence on the industry deepens, we are showing that a business can both take care of people and be profitable. Before Yemi walks us through financials, I want to highlight 3 key areas driving our continued growth. First, our investment in AI and technology is delivering a health experience that we believe no other company can replicate. Our CTO, Mo Elshenawy, is on the call today to walk us through how that is coming to life in both deeper customer relationships and increasing business efficiencies. Second, our world-class infrastructure means we can not only support customers across a greater spectrum of needs from beginning to end, but also safely enter more complex categories at a faster pace and at a greater scale than others in the industry. And third, our global reach, when paired with our technology and infrastructure, has created a platform that shows customers and industry leaders alike that access to high-quality care can be personal and widely accessible. Hims & Hers is building something entirely new, and it is increasingly difficult to replicate. Nearly 3 million customers believe in a future of health that is proactive, personal, and built for their lives, and we are thrilled to be the partner bringing it to them every day. Let's start with our investment in AI. By weaving AI into the entire platform, we'll deliver a unified AI-native health experience we believe no other peer or LLM can match. Mo, our CTO, will walk us through what that looks like for our customers and the early success we've seen. but I want to start with the why. Why we are taking this approach and why we know it is the path to dramatically improving the care experience for customers everywhere. In the second quarter, we welcomed more than 300,000 subscribers, bringing our global subscriber base to nearly 3 million people. To put that into context, we are now serving a patient population that rivals some of the largest healthcare systems in the United States. And unlike frontier AI companies that many people currently rely on for day-to-day advice, we support customers through their entire health journey, from their very first question to their clinical treatment and continued follow-up care. That end-to-end closed-loop relationship combined with our scale is incredibly powerful. Customer trust isn't something you can buy. It has to be earned. For 9 years, millions of people have trusted Hims and Hers to help them feel comfortable seeking care for conditions that should be normalized. We have earned that trust by listening to their concerns, refining solutions to meet them, and delivering outcomes year after year, specialty by specialty. 9 years of data that deepen our evidence base of what works, for whom, and why. That accumulated understanding is what makes our platform different. It's powered by the millions of customers who have shown us just how impactful great care can be, and that's why they trust us with what comes next. Other health companies major in the minor. They tack on minor improvements to the existing system while we're making our platform completely AI native, so that our platform can provide an integrated experience that is alive and personal. One where AI coaches and support agents, a care team, a clinician, and a pharmacy are one unified system with a single goal: keeping people well. Our customers don't just ask us about their health or seek out specific treatments through our platform. They go on a long journey with us, and we believe the intelligence we're building around that relationship will make Hims and Hers their preferred everyday health partner. I'd now like to turn it over to Mo to speak more on how this is coming to life.
Thanks, Andrew. Our AI-centered technical strategy is the difference between adding a feature and reimagining the entire customer experience. We are making AI load-bearing, not decorative. We are replacing the traditional telehealth model with something entirely new for our industry: a unified care experience where customers' care team lives in a single platform that already knows them. No portals, no starting over, no explaining yourself to a tool that can only give you one-size-fits-all advice. Just care that is built for you, guided by data, delivered by clinicians, and powered by seamless technology. This is the foundational customer experience, which we plan to roll out across our entire platform over time. It leverages our closed-loop data, and it is becoming the basis for personalization across the entire journey. Smarter outreach, earlier risk signals, and tools that help providers tailor treatment to each patient. We are seeing impacts for our customers and our business as a result of this approach, and I would like to walk you through both. To start, the AI native experience we just launched for Hers weight loss customers is driving meaningful change for the people who come to us for care. We began a phased rollout in early July, and the results were immediate. Customers began engaging more often. Hers customers using the new care experience are sending 3 times as many messages on the platform, with AI answering 80% of their questions to support their treatment journey. As a result, AI has reduced non-clinical tasks like order updates and general side effect questions that are handled by our support teams by nearly 50%. We know that a lack of engagement and poor adherence can lead to poor outcomes, which is why we're thrilled to see customers having more engaged, intentional conversations without overloading our care teams. This also means clinical challenges like dosage adjustments or changes in treatments can be identified and flagged for a provider more quickly, resulting in an earlier interventions that help our customers stay on track. In just a few months, the internal updates we've rolled out are powerful enough that we have meaningfully reduced how much we rely on agentic AI customer support vendors. and eventually we expect to roll off them completely. We've built a clinically grounded agentic AI customer support experience that we believe serves our customers better. We are excited to bring the experience to more of our customers across the world, and we think we are moving closer to a future where the model we're building becomes the backbone for health platforms beyond Hims and Hers. We're also continuing to invest in our core technical foundation, rebuilding core components so that updates to our customer flow, product fulfillment, and catalog management are all modular. This will allow us to stand up new categories and markets in a fraction of the time it used to take us, at a lower cost to us, which has historically translated into lower prices for our customers. This is just the beginning of how we are weaving AI into every step of the customer journey. And these early signals are why we are accelerating our investment in bringing this experience to life for all of our customers. In the coming months, we plan to add new AI talent to the team, continue to develop our existing talent, and open an AI R&D lab in Menlo Park, where the team responsible for this innovation can work together in the heart of Silicon Valley. We expect this investment to pay for itself in short order. Importantly, we're not doing this to replace providers, but instead to elevate them. We feel strongly about always keeping clinicians in the loop and in charge of clinical decisions. At Hims & Hers, AI takes the routine work off clinicians' plate so they can spend their time on judgment, complexity, and the person in front of them. Our AI is bound by clinical protocols and guidelines developed by our medical experts, not the open internet. And every AI interaction is traceable and auditable by design. We are taking this approach because we know AI models are becoming a commodity. And on their own, they are an incomplete part of a wider health experience. The only way to confidently build an AI infrastructure that can improve clinical outcomes is by tracking those outcomes. We believe we are the only company operating a closed loop that includes the intake, the treatment, the follow-up, and the outcome at this scale. And the system learns from all of it. We believe this will have a transformative impact on our business as well. As we roll out this new experience to more customers, we expect we will improve the quality and depth of care accessed on the platform, which will in turn keep customers with us longer and bring new customers through the door. We believe this is something only we can do well. Our advantage is being an everyday partner to customers, rather than just a chatbot that lives on their home screen. We walk alongside our customers throughout their entire journey, helping them find qualified providers and treatments that work. We've built an AI infrastructure that learns not just what works, but what works best for each person. And we have the scale to do it with millions of customers globally, creating an ongoing cycle of improvement. Better care produces better understanding, and better understanding produces better care. This is how we are reshaping what the world thinks is possible in health, and we're only at the start. I am excited to come back next quarter with updates on the progress we will continue to make here. Thank you.
Thanks, Mo. I'd like to move us to the second area of focus for today, our growing ability to do more for the people who trust us with their health, and why that matters now more than ever. We can support customers across a wide spectrum of needs from beginning to end because we've spent years building an infrastructure no one else has. It's why we've been able to, and will continue to, enter more complex categories with more tailored, accessible solutions. This is how we support the deep customer relationships you've heard me talk about so often. Our customers are increasingly trusting us with their care across more than one condition, and each additional need they bring to the platform strengthens their trust and extends our relationship with them. We believe we are in the best position to help millions of people get proactive about more complex health challenges that often go unseen or ignored. Testosterone is a powerful example. Most men experiencing low testosterone don't know it, and they chalk up symptoms to fatigue or aging. We've designed an experience that changes that. at-home blood collection, longitudinal tracking, and provider-guided treatment that adapts over time. And that experience is resonating. Only 3 quarters after launch, testosterone is scaling faster than any other specialty outside of weight loss. That gives us real confidence in our ability to expand not only into injectable and oral TRT before the end of this year, but also to extend this model across other specialties. That's part of why we've welcomed Dr. Anant Vinjamuri as our new Chief Medical Officer of HIMSS, joining Dr. Pat's incredible team of medical leaders who provide our clinical backbone. Dr. Vinjamuri has more than a decade of clinical experience in internal medicine, primary care, and longevity, which will be a critical part of how we build and expand our offerings in categories like hormonal health, longevity medicine, and peptide therapy. His participation at the recent PCAC hearing demonstrated just how valuable and trusted his voice is among industry leaders and regulators. And his expertise will be a fundamental part of how we accelerate into our next chapter. We've developed the infrastructure to succeed in higher complexity categories. Over 1 million square feet of pharmacy and lab testing facilities, deep expertise in sterile compounding, and a global reach. Our verticalization efforts are focused on delivering a better, higher quality experience at a price no one else can match. Which brings me to peptides. Moments like this, where a category is surging in popularity while the market is struggling to find a safe, sustainable way to support it, is where our scale, infrastructure, and ecosystem thrive. We are currently developing a best-in-class peptides experience, including US manufactured products, clinical-led guidance, and ongoing blood testing. While we wait to hear the FDA's decision on the 6 peptides recommended at the last month's PCAC hearing, we've started validation and stability testing on APIs for those peptides developed in our Menlo Park facility. This will ensure we can bring them to the market with a safe, verified supply chain if the FDA decides to allow them for compounding. In the meantime, we plan to offer access to already allowed peptides with safe and well-established supply chains before the end of the year. This will include solutions like sermorelin, glutathione, and NAD+. Finally, I'd like to discuss our third area of growth, which underpins everything we've already discussed today, our global scale. The promise of our platform started with what we could do for our customers in the US, where we have 5 specialties operating above a $100 million annual run rate. We are now bringing that comprehensive experience to customers across the world. In June, we became the leading global consumer health platform when we closed our acquisition of Eucalyptus. This was the largest acquisition in our company's history, and we now have 3 international markets outside of the US also pacing above a $100 million annual run rate. This is the evolution of the company we always knew was possible. For the first time, a single platform can deliver a truly personal, accessible, and effective weight management experience to customers around the world. Whether home is Boston, Bristol, or Byron Bay, we plan to make this true for customers in all of our specialties, and I can't wait to share more on our global plans with all of you in the coming quarters. We have the ability to create sticky relationships with millions of customers worldwide, and we believe that makes us invaluable to our industry partners. We've been thrilled with the strength of our relationship with Novo Nordisk. By working with the leading innovators in one of the highest demand categories, we're expanding our addressable market, and we look forward to finding ways to work with other partners of the same caliber. We're now giving more people access to a world-class weight loss experience than any other digital platform in the world. This isn't just a sign of our scale. It's proof that healthcare is finally adopting the consumer-centric model that is already standard in industries like entertainment, travel, and transportation. We are leading a transformation that removes the middle layers and ensures that access goes straight from innovators to consumers. We believe our growing scale and our increasing investment in our technology and infrastructure makes us structurally more efficient than anyone else in healthcare. We plan to continue to leverage our leadership position to deliver more value to customers at better prices. Put more plainly, we're playing offense, and we have the balance sheet and cost structure to sustain it in a way others cannot. This is the beginning of what our platform will deliver for both our customers and our industry partners. We believe we are not far from a future where all of us will be able to access preventative screening, the innovative medications we need to feel great, and a care team supporting our progress, all for an affordable monthly price and tailored for the life we are actually living. I'll end by saying that this quarter has been about a single word: proof. Proof that you can build a world-class health experience at global scale and a reasonable price. Proof that deeper customer relationships and a profitable business aren't in conflict, they strengthen each other. We are proving that Hims & Hers is the destination for the most comprehensive personal health experience in the industry. Nearly 3 million people rely on us daily, and that's a responsibility too big to meet with anything less than the best technology, infrastructure, treatments, providers, and platform that we can provide. You've heard me say this before, that we're building the future of health, but that future is closer than it's ever been, and it's because of the strides we're making on behalf of our customers every day. I'll now pass it over to Yemi to walk through the financials.
Thanks, Andrew. Today, I'll walk through progress made in the second quarter across our key growth levers, as well as investments we are making to bring a better health experience to millions of consumers globally and capture the immense opportunity in front of us. In the second quarter, revenue grew nearly 40% year over year to more than $753 million. Expanded assortment, new geographic markets, and an elevated consumer experience allowed us to add 300,000 net new subscribers and end the quarter with nearly 3 million subscribers on our platform. Domestic revenue growth accelerated to 16% year over year in the second quarter, as U.S. operations generated $622 million of revenue. The pivot we made in March to expand the assortment of branded weight loss products on our platform was a key driver of the re-accelerating growth in the second quarter, as more subscriber additions offset revenue recognition headwinds from the shift to a monthly cadence in branded weight loss offerings. Increasingly, we view specialties with large audiences such as weight loss and sexual health as strategically important beyond just their direct revenue contributions, as they provide advantages such as, first, a meaningful expansion of the cross-sell opportunities across the platform, as consumers often seek treatment for conditions beyond weight. Cross-sell potential increases further as we extend the reach of lab testing on our platform, which can surface underlying needs for treatment within specialties like low testosterone and cardiovascular health that subscribers may not know they have and would not otherwise act upon. What begins as a weight loss treatment has the potential to become a pathway to providing access to care for a much broader range of subscriber needs. Second, it allows us to rapidly deepen the structured data set across our platform. The more subscribers we serve, the richer our data set becomes. This allows us to equip providers with tools to better match subscribers with effective treatments, as well as design more customized subscriber tools for follow-up care. Each subscriber makes the platform smarter and better for the next. Finally, our infrastructure is built to continuously capture economies of scale. As our subscriber base grows, we realize efficiencies across our supply chain, including our provider network, pharmacy fulfillment, and follow-up care operations. This reduces our cost to serve, expanding our ability to reach more subscribers at accessible price points. Strengthening our domestic operations has provided us with the conviction to invest internationally and bring our value proposition to millions of consumers overseas. In the second quarter, international revenue increased over 17-fold year over year to $131 million. We welcomed the Eucalyptus team in June, deepening our presence in Europe and extending our reach to Australian and Japanese consumers. Eucalyptus contributed approximately $40 million of revenue in the second quarter, further accelerating our already strong existing international business that grew 13% quarter over quarter organically. Our revenue footprint continues to rapidly diversify across specialties and now also across geographies. Hers is on track to deliver north of $1 billion of revenue this year, and new specialties such as low testosterone continue to serve as strong growth drivers for Hims. In fact, in the coming quarters, we expect testosterone will become our sixth U.S. specialty to reach a $100 million annual revenue run rate. Our growing international business makes this diversification even more robust. The UK, Australia, and Germany are each already generating more than $100 million in annualized revenue, with Canada also on track to join this group as well as we scale our generic weight loss offering. We believe we have the infrastructure to improve the overall quality and efficiency of our platform as we continue to scale. Our aim is to continue to drive scale, but do so in a thoughtful way that lays the foundation for robust EBITDA and cash flow generation. Our second quarter results reflect that discipline. Adjusted EBITDA in the quarter was $60 million, representing an 8% adjusted EBITDA margin. This represented a 1-point improvement quarter-over-quarter as operating leverage more than offset gross margin headwinds from the ongoing mix shift toward weight loss and the accelerating revenue contributions from our international business. These results exclude approximately $81 million of non-recurring costs incurred during the quarter, consisting of acquisition and transaction costs primarily related to the closing of our Eucalyptus acquisition, restructuring costs following the strategic pivot in our weight loss specialty earlier this year, and legal contingency accruals related to recent litigation with the FTC. Let me briefly address that last item directly. As disclosed in our filings, following nearly 3 years of cooperation throughout the FTC's investigation and several months of good faith settlement negotiations, the FTC filed a complaint on July 29th. Ultimately, we were not prepared to accept the terms we do not believe reflect the facts or the law. We are confident in our position and intend to defend it vigorously. These one-time costs primarily impacted G&A, operations, and support costs during the quarter. Unless otherwise noted, the remainder of my commentary today reflects our results excluding these costs. Gross margins in the second quarter were 64%, down approximately 6 points quarter-over-quarter on an adjusted basis. This compression reflects deliberate strategic action to scale the specialties and markets that we believe will drive the long-term value of our platform. We do not believe anyone else in consumer health has the scale, infrastructure, and balance sheet to invest in this way. As branded weight loss products and international revenue become a larger portion of the business, we expect gross margins will remain below the levels we have historically achieved. What matters to us is that the underlying unit economics of the platform remain strong, and that each of these investments expands the base of subscribers we can serve and positions us to unlock efficiencies across our platform over time. In recent quarters, a meaningful portion of our investment has gone into technology and G&A as we've leaned into the engineering and AI organizations and the leadership talent required to deliver a first-of-its-kind health experience to consumers around the world. That investment will continue, but we were encouraged to see modest sequential leverage across both lines this quarter, which we believe offer an early signal that investments here can be meaningfully accretive over time. Those investments are also beginning to generate cost savings elsewhere in the business. Operations and support delivered 3 points of sequential leverage in the second quarter. This is a reflection of the improving efficiencies we are driving across our pharmacy operations as we increase throughput and early cost savings from the AI initiatives we have deployed across customer support. As Mo mentioned, successful pilots have demonstrated that AI has the capacity to drive a 50% reduction in non-clinical tasks handled by our support teams. Early signs in the same pilot are also demonstrating stronger engagement and lower cancellations for the participating subscribers. As these capabilities mature, we expect the overall subscriber experience to improve and our cost to serve to decline. Finally, we continue to increase efficiency in our marketing spend as we scale. Marketing as a percentage of revenue improved 5 points year-over-year and 2 points quarter-over-quarter to 34%. Many of the drivers here remain consistent with past quarters, strengthening retention, improving rates of cross-sell occurring organically across the platform, and years of brand investment helping to lift customer acquisition in lower cost channels. With that said, we also see 2 new dynamics that are presenting additional opportunities. First, our collaborations with the pharmaceutical innovators like Novo Nordisk are resulting in real marketing tailwinds. We've seen groundbreaking treatments draw enormous consumer attention to categories like weight loss, but when people go looking for a trusted, approachable place to start, they increasingly start with Hims and Hers. We built a platform that makes health simple, personal, and easy to stay with, and that is allowing us to turn consumer curiosity into new care relationships in an increasingly efficient way. Additionally, our expanded international presence unlocks the potential for larger, global brand moments while also driving far greater optionality in where we can deploy capital to drive awareness of our platform. We believe we are in one of the most exciting stages in our history. It is a stage that demands we lean into investment, act decisively on the right M&A opportunities, and attract the caliber of talent that enables us to capitalize on the significant growth runway in front of us. Periodically, we expect this long-term oriented mindset will impact our GAAP results, and that was the case in the second quarter. GAAP net income was a loss of $86 million, which was impacted by the previously mentioned non-recurring acquisition, restructuring, and legal costs. Over the last 12 months, our platform generated over $260 million of operating cash flow. That's inclusive of second quarter results, where our operating cash flow momentum took a pause due to the increased working capital demands associated with our rapidly expanding branded weight loss offering. During the quarter, operating cash flow was negative $36 million, and free cash flow was negative $68 million. Since the end of the first quarter, we successfully completed 2 actions that we believe will help ensure our balance sheet will not limit our ability to capture the growth opportunities in front of us. First, we established a $400 million receivables facility, giving us an efficient mechanism to convert the growing base of short-dated receivables generated by our branded weight loss offering into cash with capacity that scales alongside the business. Second, we completed a convertible debt offering over $400 million, further reinforcing our balance sheet. Our expectation is to resume free cash flow generation in the second half of the year. After accounting for the approximately $225 million upfront payment made at the closing of Eucalyptus, we ended the quarter with more than $840 million of cash and short-term investments. We also have $225 million remaining on our share repurchase program, which continues to give us the ability to act when we believe the market value of our stock disconnects from its intrinsic value. Taken together, our balance sheet, our access to efficient sources of liquidity, and the cash generation of our domestic business give us the flexibility to fund an accelerating platform while continuing to invest with conviction. Our investments will continue to orient around our core strategic growth levers, which we believe will solidify the path toward our 2030 financial ambitions. Utilizing technology to elevate the quality of care for our users, expanding into new specialties, broadening access to personalized care across specialties, leveraging partnerships to become a best-in-class curator of health services, and expanding internationally. I'll highlight a few of these where we expect heavier near-term investment. First, we are accelerating investment in our technology and AI capabilities. AI investments on our platform are driving a meaningfully better consumer experience that is resulting in a reduction in cancellations. Subscribers are able to get faster answers to questions alongside a more consistent and personalized experience. Early signals are already demonstrating AI's ability to improve the efficiency with which we serve our subscribers. We expect these benefits to compound with time, unlocking a powerful combination of stronger revenue growth and cost savings. Our expectation is that the AI investments will pay back within 12 to 18 months. More importantly, we believe these capabilities, combined with our scale, provide structural advantages to reinvest in ways that others cannot across key growth areas like weight loss and international markets. Starting with weight loss, we will deploy a portion of efficiency improvements from AI into making our platform the most accessible place for consumers to begin their weight loss journey. If success across our AI efforts continues, our expectation is that we will unlock more value for our weight loss subscribers by the end of the year in the form of lower prices and our additional tools. This is a playbook we know well. In our sexual health and hair loss specialties, scale allowed us to steadily lower prices for our customers, which expanded our addressable market, strengthened retention, and ultimately drove stronger LTVs and margin expansion. We see a similar opportunity taking shape in weight loss, where our growing scale, improving operational efficiencies, and AI-supported care model enable us to make treatment more affordable for more people. Delivering more for less is how we extend the advantages of our platform, and we believe Phio and Consumer Health are positioned to do the same. We also expect to redeploy a portion of efficiencies to accelerate growth within our international business. We have the necessary talent to meaningfully evolve the way consumers access their health and wellness needs across Australia, Japan, Canada, Germany, and the UK. And we expect to invest aggressively in these markets as we build category leadership. Importantly, adoption of weight loss solutions across many of these markets still lags the US meaningfully, and the same investments that strengthen our leadership position can accelerate growth of the category itself, expanding the market for us and for our industry partners. We expect these markets to emerge as meaningful profit centers as they scale. Lastly, we will continue investing in the operational capabilities and clinical oversight required to bring new offerings to the platform responsibly, including higher complexity offerings like injectable testosterone in the near term and peptide therapies if the regulatory landscape allows. With that, I will walk through our outlook for the remainder of the year. In the third quarter, we are anticipating revenue in the range of $880 to $900 million, representing a year-over-year increase of approximately 47% to 50%. We expect adjusted EBITDA to be between $75 to $95 million, representing an adjusted EBITDA margin of 10% at the midpoint of both ranges. For the full year, we are raising our 2026 revenue outlook to $3.1 to $3.3 billion, representing a year-over-year increase of 32 to 41%. It is our expectation that 2026 adjusted EBITDA will be between $275 and $325 million. These adjusted EBITDA and revenue ranges imply an adjusted EBITDA margin of 9% at the midpoint of both ranges. To help contextualize our outlook, I will highlight a few points. First, we expect the gross margin dynamics we saw in the second quarter to persist through the second half as branded weight loss offerings and international revenue continue to grow as a share of our business. As I discussed earlier, this mix shift reflects a deliberate decision to scale the specialties and markets we believe will drive the long-term value of the platform. Second, we expect the compounding effect of the weight loss cohorts acquired throughout the first half to drive a meaningful step up in adjusted EBITDA dollars in the second half, accompanied by continued leverage across our operating expenses as revenue growth in the US reaccelerates. At the same time, our guidance is designed to preserve the flexibility to lean further into the investment priorities I outlined today as opportunities materialize. Finally, we expect our international business to generate at least $600 million of revenue in 2026, which will continue to operate at or near break even on an adjusted EBITDA basis as we prioritize scale. Our platform is delivering a combination of value to consumers that we believe cannot be found anywhere else in healthcare. We are addressing more health needs for our subscribers through an experience that becomes more personal with every interaction at prices that become more accessible as we scale. That combination is why more people are choosing our platform than ever before and why they are staying longer and trusting us with more of their health. What's most exciting is that now this is a truly global story. The reacceleration underway in our US business is paired with leadership positions across key international markets, giving us more consumers to serve, more markets to scale, and more ways to compound our advantages than at any point in our history. All of which reinforce our confidence in achieving our 2030 ambitions of at least $6.5 billion in revenue and $1.3 billion in adjusted EBITDA. Our success would not be possible without the significant efforts of Hims & Hers employees around the world. I'd like to thank them, our subscribers, and our shareholders for supporting us in our mission to help the world feel great through the power of better health. With that, I will now turn the call back over to Bill to kick off Q&A with 2 questions from our retail community.
Thanks, Yemi. And thank you to everyone who sent us questions over the weekend. Our first question comes from the Hims House community who would like to better understand how we're approaching the developing opportunity in peptides. They ask, following the July PCAC recommendations for the 5038 peptide list, can you provide more detail on your go-to-market timeline once final FDA guidance is provided? Are you compliance ready to launch within weeks given your existing California facility, or are there additional build-out steps that push this into 2027? And do you still intend to let others go first, or has the July recommendation changed that calculus?
Yeah, great question. Thank you for that. As we've said in the past, I'm extremely excited about this category holistically, the peptide and wellness category, and was very excited to see 6 of the 7 go through successfully with the PCAC meeting at the FDA a couple of weeks back. To your question on timing, we've made incredible progress in the last couple of quarters on the clinical guidelines as well as the supply chain. That gives me confidence that if and when the FDA does decide to move these peptides to the Category 1 list, we'll be able to move extremely quickly. Specifically, we brought on Dr. Anand Vinchamori as our Chief Medical Officer on the Hims side of the house, who is an expert across hormonal therapy, longevity, and peptide therapy. He's been building out the clinical protocols, the guardrails, the dosing regimens, and the provider training. In addition, in Menlo Park, in our API facility, where we have committed to actually manufacture the raw APIs in the US, which we think is extremely rare and likely the only company capable of delivering that. We are in the process of actually putting on BPC 157 onto stability and validation testing to be ready shortly and following course with the remainder. So in the meantime, as we await FDA decision-making and rulemaking, we will be moving forward with the wellness and peptide category with a broader set of offerings. These include things like Sermorelin, glutathione, NAD+, and other wellness therapies and injections. And we expect hopefully that to come out by the end of this year.
Great. Thanks, Andrew. The next question comes from Tom T, who asked about the investments we're making in AI and our longer term vision for kind of what the Hims and Hers customer experience can look like. He asks, between labs, potential wearable partnerships, and the treatment and outcome data you're collecting from millions of customers, is there a plan to bring all of that together so a customer can eventually see something like a real-time health score, where the AI is connecting those data points, flagging things early, and recommending next steps before they become actual problems? How far away do you think something like that is? And is that something the team is actively building toward today?
Absolutely. The short answer to that question is yes. We are also hiring, so you're able to piece a lot of that together, so please apply. But the vision really is to be able to bring together all of the elements of a 360 person's health, whether that's wearable data, our own devices, external devices, lab testing data, our own labs, external labs, all the way to preventative screening and genetics, to be able to have an ecosystem of doctors, specialists, coaches, agents, pharmacists on call for you 24/7, actively monitoring how best we can assist you with living the healthiest and best life. I think this sets up very well for a natural membership offering for Hims and Hers that you could imagine coming out, in the coming year or two. I think this also sets up a really powerful freemium offering for Hims and Hers, where patients could just have the opportunity to come leverage these tools at Hims and Hers in a free manner to just get benefits of the 360 view of their health, a unified platform with an ecosystem all powered by AI on the bottom layer of actual doctors, actual trained nutritionalists, as well as agents and care pilots. And so when you really step back, like what this is that we're building is currently available. This is what most would consider concierge care today. And, it costs anywhere from $50,000 to $150,000 annually. I think in the simplest way, my vision is to make that same level of proactive, preventative, always-on care affordable to everybody globally for a price that is universally accessible.
We will now begin the question and answer session. Please limit yourself to one question and one follow-up. If you would like to ask a question, please press star 1 to raise your hand. To withdraw your question, press star 1 again. We ask that you pick up your handset when asking a question to allow for optimum sound quality. If you are muted locally, please remember to unmute your device. Please stand by while we compile the Q&A roster. Your first question comes from the line of Maria Ripps with Canaccord. Your line is open. Please go ahead.
Great. Good afternoon, and thanks so much for taking my questions. I wanted to ask about the Novo partnership, which clearly has been very successful on the volume side. So now that the branded cohorts are a couple of quarters a couple of quarters mature, how does their retention and engagement compare to what you saw historically across other products? And then how are you thinking about sort of deepening the Novo relationship from here? Thank you so much.
Yeah, maybe Yemi, I can speak a little bit about the relationship generally and opportunities, and then you can dive into the retention profiles. Maria, at a high level, we're extremely excited by the ongoing relationship with Novo Nordisk. Top down from Mike as CEO, the team has been incredibly collaborative in thinking through ways in which we can broaden access to patients in the U.S. The Wegovy pill has had a staggering launch, and I think we are the largest or one of the largest players that are helping people access that pill, which has really opened up the floodgates of people who had injection fears, price point fears, and concerns. And so very strong relationship domestically. We also have extremely strong relationships internationally and are adopting many of those relationships from our acquisition with Eucalyptus. So this is across Germany, across the UK, where we were actually able to help generate tens of thousands of individuals on a wait list for the Wegovy pill within just a couple of days in some of these markets as they were getting ready to prepare the launch. I think there's an increasing amount of collaboration around key strategic markets that are valuable to both businesses, and thinking about how to collaborate into expanding the market and getting people more access. I think there's increasing ability to share data with regard to what's working for patients, adherence benefits, what we're seeing with regard to side effects or how to mitigate that and different dosing regimens. So I think there's a really powerful flywheel here when you start getting the leading drug manufacturers actually closer to the data on the ground of the consumers in a way that can not only help when it comes to commercializing therapies, but also thinking through how we bring new therapies to market. And so I think there's a growing set of opportunities that I think both of the teams are very excited by.
And then to hit the second part of your question, Maria, really, I think we're seeing retention aligned with our expectations. Part of the beat in Q2, or a large part of the beat in Q2, was a result of really the weight category, amongst others, being much stronger than we thought. As we saw that, that's what gave us conviction to elevate the guidance for the rest of the year. Perhaps what's even more exciting for us is that we see the experience continue to get better. And so in the prepared remarks, we spoke around how with a more immersive experience through the next evolution of the app and some of the AI tools, as well as physical tools like the scale that consumers are getting, that enables more connectivity with their providers. And ultimately, we're already seeing signs of lower cancellation rates for the cohort of users that are receiving that. And so as we look to continue to invest in the experience and we see opportunities, as we gain more efficiencies to make price points more affordable, we see an already solid retention rate getting stronger and stronger.
Your next question comes from the line of Ryan McDonald with Needham. Your line is open. Please go ahead.
Hi, thanks for taking my questions. Congrats on a nice quarter. Andrew, as we think about as you're integrating Eucalyptus now and the international acquisitions you've made, can you just talk about what some of the key specialty areas that you're seeing the most success with in those international markets, and where you see the potential low-hanging fruit to expand assortment in some of those markets, particularly for Eucalyptus, that are already quite strong within the U.S. market? Thanks.
Yeah, great question, Ryan. Some of the, specifically Eucalyptus, has done a wonderful job building real dominance in the UK, Australia, and Germany, and newly in Japan and Canada, in the weight loss category. So they are serving that demographic very well. One of the leading, if not the leading providers in those markets, and in aggregate, the leading digital health providers in those markets, where we think there's real opportunities actually bringing some of the core specialties that the Hims & Hers business have gotten very good at here domestically overseas. And so these include things like testosterone replacement therapy, menopause therapy for women. This is basic assortment in the dermatology category, such as men's and women's hair, men's and women's sexual health and reproductive health, as well as categories like peptides in some of these markets where actually there are different regulatory opportunities to expand and allow patients to have some of these more cutting-edge longevity therapies. And so I would say at a very high level, there's some very low-hanging fruit in bringing some of the best and highest performing and even some of the fastest growing, like testosterone categories that are here domestic, into at least 5 or 6 markets overseas with the engine and the go-to-market commercial strategies that the Eucalyptus team is already well equipped to deliver on.
Appreciate that. And then as a follow-up, maybe just a clarifying point with on the peptides. I know you talked about, addressed it a little bit in the question earlier and all the preparations going on there. But in terms of when you could, or I guess maybe the catalyst you're waiting for, would you be waiting for sort of the full formal FDA guidance, that's in the register that can take sort of the 6 to 12 month process to start selling the 6 of the 7, or does it simply sort of the proposed rulemaking process kicking off with the commenting period, et cetera, sort of act as more of the signal, sort of a nearer term opportunity for you to start selling those 6 approved peptides? Thanks.
Yeah, thanks, Ryan, for the clarification. Our operating model today is that we are waiting on full and final rulemaking from the FDA. And so that could come in a lot of different forms and factors. It could come on different timelines. But we think it's really important for them to complete that process before we bring this to market.
Your next question comes from the line of Mark Mahaney with Evercore. Your line is open. Please go ahead.
Thanks. I'd throw in two questions, please. Just on the eucalyptus contribution in the back half of the year, first to the EBITDA, kind of shading down or cut in the full year guidance. I know you mentioned investing in AI and in further international expansion, but is eucalyptus dilution part of that kind of shade down in the EBITDA growth for the full year? And then just on the U.S. acceleration that you saw in Q2, and you talked about, I think it's implied in your guidance for the back half of the year, and I think that's largely due to the kind of the broadening of the weight loss offerings that you have. Would you want to help us quantify like how much more acceleration we could expect, in the back half of the year? Thank you very much.
Yeah, thanks for the question, Mark. We'll maybe take the second question, in that it effectively, is a catalyst behind the first. So we are expecting, greater acceleration on both revenue and EBITDA in the U.S. and in the back half of the year. Really, one of the driving forces, behind that are a few things. The first is just given the switch, particularly on the branded products, to a monthly cadence. As you start to see more cohort stack, due to greater tenure of the offering on the platform, that inherently results in both more revenue, and EBITDA. So we would expect those effects to start to compound in both Q3 as well as Q4. You already saw that to some degree with the roughly 12-point acceleration in the first quarter. I think to compound that as the experience gets better with some of the elements that Andrew mentioned, as well as Mo mentioned in the prepared remarks around the AI and some of the tools that subscribers will be equipped with. Inevitably, our view is that the ability for retention to get stronger only increases, which will drive that acceleration further. Then I think what we're seeing is as we see efficiencies, across the portfolio, both in the U.S. but particularly some of the early savings that we're receiving from AI, that will be reinvested into really two areas. The first is taking some of those savings and reinvesting it into a more immersive weight experience that passes more value to the consumers. That can be in the form of making the price points more accessible. It can also be in the form of more tools and just thinking through how to increase the stickiness in the platform. The other area where we're prepared to invest, we see an ability to secure leadership across many areas. As we look at particularly attractive markets in Western Europe like the U.K., Germany, as well as Canada, having the strength of the U.S. and domestic portfolio to really lean in there, something that's reflected in our guide. And so in our guide is the flexibility to make price points more accessible here domestically, but also really to, as we see opportunities to invest in ways that adhere to our capital allocation standards of the 1 year or less break-even period, we will do those particularly across in international markets.
Your next question comes from the line of Craig Hettenbach with Morgan Stanley. Your line is open. Please go ahead.
Yes, thank you. On the push to drive AI adoption, anything unique on the Hers side in terms of starting there, and then the rough timing of when you'd expect to see that on the Hims side as well?
Yeah, thanks, Craig, for the question. Yeah, we're incredibly excited by this, as we shared in the prepared remarks. I think seeing on the Hers side meaningful acceleration in engagement, patients are interacting and messaging with their care teams 3 times as much with the new care operating plan and operating system that we've rolled out. And at the same time, the actual tasks for humans has dropped 50% when you're talking about non-clinical tasks. And so this really rare combination of extreme engagement that we know has long-term trickle-down benefits when it comes to cancellation reductions and retention, as well as very real cost savings that, to Yemi's point, we can immediately redeploy into more aggressive pricing and market capture opportunities in the weight category as well as the international category. We started with the women's weight loss business. because that is one of the highest engagement parts of the business. It's a category that there are a tremendous amount of questions. There's an incredible complexity with regard to injection fears, dosing regimens, side effect mitigation. It is probably the most complex category we operate in today. And so building the operating system and kind of this AI platform that can connect a pharmacist, a doctor, care coaches, agents all together in that environment, we thought was the best place to start. We are quickly rolling this out to other markets. We plan to bring, as we've shared, some of the other therapies and peptides to market that are currently already on the Category 1 list, as well as expanding the TRT offering with injection testosterone as well as oral testosterone. And the plan is to be able to have this new experience powered by AI for some of those new category launches on the Hims side of the business as those come out in the next couple of quarters.
That's helpful. And then just a quick follow-up, Andrew, as you kind of step on the gas here with new product categories, you've talked about all the technology capabilities and AI as well as kind of the reach and capacity. How are you prioritizing these new categories? Is there anything in terms of like thresholds or things that you look at from a market perspective that kind of green lights some of these new categories versus others that maybe you might ultimately take more time with to launch?
Yeah, it's a great question, Craig. We're at a scale now with nearly 3 million subs globally where the patients do a fantastic job of telling us where the business needs and the clinical needs exist. And so really core to this strategy was the lab testing infrastructure that we acquired and have rolled out in the last few quarters that will be bundled with a lot of these categories that we were just talking about and essentially free with your care. And what we've seen from that adoption is exactly where we need to be going. We're going towards metabolic health with broader sets assortment on the GLP-1 side. We're going towards hormonal health because we're seeing both on men and women massive overlap between those patient populations. We're going towards sleep and recovery and longevity focus because that's what people are telling our providers that they're interested in or struggling with. And so we're at this really powerful point in the flywheel where the scale of the business, the high engagements we have with patients on singular categories really feeds and accelerates our understanding of new categories, our understanding of the cross-sell potential of those categories, and ultimately what the overlap will be. And so I think over time, that assortment and that breadth is a massive competitive advantage. As we shared in the remarks, with testosterone, we're approaching 6 categories, growing over 100 million run rate. I think that assortment is going to continue to accelerate the pace at which we can bring new things to market and the pace at which they hit that 100 million run rate threshold, just because they will be more informed by existing patient populations with much more clear targeting and the ability to bridge patients to more comprehensive care.
Your next question comes from the line of Eric Percher with Nephron Research. Your line is open. Please go ahead.
Thank you. Andrew, I'd like to follow up on that comment about 3 million subs. It'd be interested to hear your perspective on the recent growth and how much of that may be a bolus that was waiting versus the ability to maintain it. And then, Yemi, I also want to check to see, does that growth that we saw quarter over quarter include eucalyptus subs as well in a meaningful fashion?
Yeah, great question, Eric. I'll let Yemi speak to the eucalyptus contribution. I think a big part of this, came from the pivot in the business to expand the offerings on the weight loss side to bring some of the new therapies onto the platform. There's obviously just a tremendous amount of demand for these therapies. And I think building the business model in such a manner that allows us to have very close and mutually beneficial relationships with the large drug companies and the large biotech companies is going to continue to allow for this type of accelerated growth as new therapies come to market where consumers have excitement and there's great business potential. At the same time, I think there's been also a reacceleration across categories. Most notably on the men's hormonal side of the business, within just a couple of within a couple of quarters, has become the fastest growing business outside of weight loss, and quickly will be eclipsing that 100 million threshold. And so we're continuing to lean in on that category, expand assortment of that category, bring that overseas. But generally, I think it's a nice combination of the business model, expanding great options on the metabolic side of the house, as well as the traditional core Hims businesses reaccelerating as we put more focus into some of these new initiatives.
Your next
And then to hit
question.
the second part. I'm sorry, to hit the second part of your question, Eric. The short answer is eucalyptus, stuff as well as revenue is included in the second quarter results. On the revenue side, is roughly $40 million coming from eucalyptus. Overall, and a material portion behind the guide is really just the accelerating domestic revenue. The assortment in the weight category, definitely has been a catalyst towards, us being able to accelerate the trajectory on both revenue and subs there. But then also on the Hims side, as we see continued success with, things like the low testosterone offering, and some of our other newer specialties. As those scale, we continue to, see the domestic business thrive, which provides more dry powder to invest in the international markets.
Your next question comes from the line of Glenn Santangelo with Barclays. Your line is open. Please go ahead.
Oh, yeah, thanks. Two quick ones for me. Hey, Yemi, I just want to follow up on Eric's eucalyptus question. In the past, you told us that eucalyptus was currently, generating about a break-even margin. Is that still the case? And any help there you can give us? And then my follow-up is really around longer-term margins. If you look at your 3Q guide, the implied margins in the fourth quarter, I think you're calling for 12%. EBITDA margins are 12% at the midpoint. Is that math correct? And is it reasonable to use that as sort of a jump-off point when we think about fiscal 27, appreciating that's still, a few months away, and I appreciate you don't want to say much about fiscal 27, but I'm just trying to think about the margin trajectory, given you're sort of confirming, that 20% margin in 2030. Any sort of, insights you can give us on how we should think about that would be helpful. Thanks.
Yeah, thanks for the question, Glenn. To hit the first part of your question, for, eucalyptus, I think that roughly, they were running at break even to moderate losses. I think as we see continued strength in the US, the international markets are something that we're prepared to lean into in a thoughtful way. Collectively, we do expect those to be either near or at break even. But as opportunities, permit, I think that's one of the beautiful things about the domestic and the domestic acceleration that we're seeing, that provides the opportunity to invest there. On your second question around just the longer term margin profile, not necessarily prepared to speak to 2027 yet, but we'll really just kind of reorient towards what does our philosophy look like for the next couple of quarters as we continue to lean in and invest. And really that's towards first and foremost strong free cash flow generation, as well as strong EBITDA dollar generation on an aggregate basis. And so as you see that the stacking of the cohorts, particularly in the weight loss category that we spoke around before, as well as some of the benefits coming from the ramp in newer specialties that Andrew mentioned, those things give us conviction to be able to invest aggressively, but still drive the strong cash flow generation EBITDA dollars.
We have reached the end of the Q&A session. This concludes today's call. Thank you for attending. You may now disconnect.
So, a little bit of my thoughts. I'll give you guys the bad, and then I'll give you guys the good. It's a very mixed quarter for me. I'd say they're chewing a lot off at once. That's kind of like my first impression. Like, I'm all for growth, but they are chewing a lot off, and it also kind of happened out of their control because back in 2020, 25, they started their international expansion journey, which was cool. And at that time we had no time frame on, peptides, and you needed that other growth driver. You didn't really know what was going on with the GLP-1s. You had the Novo potential lawsuit they were kind of fighting, and so they were trying to find other growth drivers. Well, now as peptides are launching, you get the API facility. I do like the AI initiatives, but I'll get into that next. But then you also have the Silicon Valley, which I like. That is a good investment. I think that if you have an AI team, they should be working in an office together. You guys should not be working from home. Like, how do you have any chemistry? How does anybody push each other to actually, meet deadlines, not even on time, but ahead of time? So I do think that is an underrated thing that they brought up. But yeah, so I'd say the biggest risk in this whole earnings call is just all the upfront costs they're taking on to then lean into growth. I'll get to these questions a bit on after I reach my main points. And then you guys saw me on my phone. It's because I was taking notes as the call was going. So the one thing I did want to say is they mentioned oral testosterone, and the first thing I thought of was Kaisertrax was supposed to come in the first half of this year, and so he never said Kaisertrax specifically. So I don't know if they want to deliver their own oral testosterone through the same method that they're planning on doing with the compounded GLP-1s when they originally got sued by Novo. I forget the exact terminology that it is. Or if they are actually going to finally partner with Kaisertrax here in the second half. But a big important point that many of you guys don't know is, so if testosterone actually does reach 100 million by the second half of this year, it would have done it in about 12 months. And the fastest product in Hims umbrella to ever get to that amount of revenue that quickly was GLP-1s. So I'm not saying that it's the next GLP-1 product for them, but it is going at a very fast scale, so that is a positive take. I do think it benefits off of all the new subscribers who came from for GLP-1s, but it is still nice to see that second growth lever is flourishing. The other thing I wanted to mention was, okay, they said eucalyptus at 40 million, so I was right in my calculation on that when I did the estimates. I had 39 million. So the AI I like because more engagement and better retention. So the payback period is 6 months. The issue is you get a GLP-1 customer on board. They do the $39 a month. You are losing money up front just to get them in the door. And then I do not think they make, through the partnership with Novo, a terrible amount of money, economics-wise, by selling their branded product. I think it's the membership, and then they get a little bit of the cut, but not much, because they sell it for the same price that Novo sells it through their site. So by increasing that engagement, one, they're in the app more, they're more likely to get pushed to another product, maybe labs leads into the hormonal treatment. So I'm a fan of that, and we're seeing longer retention, as I said. And so the longer these customers are in, well, now they're no longer paying $39 a month, they're going to be paying the $140 a month, and you're not going to have to pay as many customer acquisition costs to, get the growth you want. And you're going to start seeing that revenue hit the bottom line. So that is also good. They're going to get free cash flow back in the second half of the year. Also good. I was not happy seeing that negative. They did just say second half of the year, so I don't know if quarter 3 it's going to show up as free cash flow negative again for the quarter. All they said was second half of the year. So that also had me scratching my head, and I'm not necessarily happy with. And mainly because it's frustrating as a shareholder, because I want to let the thesis play out, and I still think there is a thesis. It's just taken longer than when I initially got in the position. I think that, 2 years ago when I got in this, I didn't think I'd be in this situation anymore. I couldn't have predicted every event how it went, but the one good thing I could take is it's still above my $20 average. So I can't be that upset, but at this price, it's one of those things where it's like, okay, I'm still just going to let the thesis play out. It's just starting to pan into more of a, 2027 thing. And then I like that they're delivering APIs in the US. I had a feeling they would want to do that. They've made it clear that, their offering is going to be differentiated because unlike these other telehealth providers who are probably going to get APIs from China, I mean, even now we were getting APIs when we did compounding, some of them from China. So you're going to start getting APIs for the peptides here in the US, and they sounded pretty ready to go to market once the FDA moves forward and hopefully moves those to the bulk 503A books list. And then, okay, yeah, they also said that they were seeing clinical tasks, non-clinical tasks, they were doing down 50% thanks to the AI, which was also positive. Now, I want to get to some of you guys' questions real quick. Thoughts. Okay, I think this was the first one. Not sure about who you're talking about, but I started in. Okay, you were answering them. Yeah, and then. And okay, I must say this anyway. So he said, not sure about who you're talking about, but I started investing in HIMSS 2 to 3 years ago, and they were actually starting to be very profitable. So of course, that these quarters look painful now. And yeah, I agree. This is kind of exactly what I was just pointing towards. 2 to 3 years ago, 2 years ago when I got into this company, they were starting to grow EPS. They were growing it pretty quickly. You even landed a partnership with Novo back then before it broke up, and honestly, cutting some, I'm a batch management real quick. If they don't blow that up, nothing probably changes, and you can probably still hold profitability, and this could have been smooth sailing. Now, it is what it is now. When I entered the position, I told myself I expect management to do something dumb at some point. And I said that because one, you are in a highly regulatory industry, but also the CEO was 35. Like, he was bound to do something stupid that I didn't like. And, looking back is always 2020. I can't, it's kind of hard to recall exactly how I felt. I remember what it felt like when I watched my portfolio fall 20%, but yeah, it's frustrating now, for sure. So then all I hear is we will start peptides, we will use AI, and this is growth. Still no real progress. Everything is ands, buts. I'd say the one positive you can say is they're showing real use cases that the AI is working. So they're not just using AI as a buzzword, but they're using it to actually increase productivity. I mean, the less time pharmacists are needed to take care of customers or whatnot, it's honestly the less overhead you need. So if you can make the process easy and reduce the amount of people needed in between, or even just increase the amount of care you're able to give, and it reaches customer satisfaction, like they said, it increases retention. So if you can increase retention by, investing in AI now, I mean, once you invest in AI, it doesn't keep eating your dollars. So I do think it's a smart thing to do. I like the AI thing. They definitely harped on it. I don't know if it's to try and pump the stock. I'm not really going to look into that, but Some people will. And then peptides, yeah, of course. Peptides are one of the biggest bull cases. Of course, they're going to talk about peptides. I mean, if you're not in HIMSS for peptides, it's kind of like, what are you in it for? It's definitely a part of the big bull case. And that was the other thing I wanted to mention that I skipped over, is they're launching NAD+, Sermorelin, and it's like Lissa. I don't know the other one. I know Sermorelin and NAD+. NAD+ is for like anxiety, and then Sermorelin, someone can correct me if I'm wrong, but I think it's a recovery peptide. For like weight, people in weight training will use it. It might be for sleep, but I think it's for recovery. And then you said, how shouldn't it be? They started to expand into over 5 new countries, new products, even products. Even in products they cannot sell right now, peptides, they're all profits in the future. They are, but at the same time, you invest too heavily, you have some sort of economic downturn, unseen event. That's how a company goes bankrupt. And I don't think you want to watch your ticker go to zero. Pondering selling a few shares to buy Rocket Lab, which has already dipped a bit, as I expect. HIMSS to dip more to my average 29.18. Yeah, I mean, do what you think is right for your portfolio. Like I said, nothing I say is financial advice. I'm personally, at this point, I expect it to just chop 20 to 30. I even mentioned it earlier before the first stream flopped because of technical difficulties. But I expect it to chop there. I think what I'll do is just like sell covered calls, take advantage of the premiums this ticker gives me in the meantime, and if it runs, I always will still have the opportunity to hold on to my shares. I can roll them as long as I want. So I'm not really worried about that. I'm young. Other people are in different boats. Thoughts on competition with Roman Health? I think Roman Health is a non-factor. They're half the size, and they're still only on they're still only on iOS. I assume you won't sell your shares, but how much as a percent of your portfolio is HIMSS? So HIMSS is about so it's hard because I have like a bunch of cash secured puts and none of them are on HIMSS, and I count that as part of my portfolio. But between Zeta, SoFi, and HIMSS, I have 500 shares of each. Now, HIMSS, when it originally, at one point I was all in, and then I sold, which I went all in at 20. And then I just kept selling covered calls and cash secured puts, and then over time I just invested into other positions. And now SoFi, Zeta, and HIMSS, they're all 500 shares, but then I have like 5 cash secured puts on SoFi. And so what I'm going to do is I'm going to keep holding on what I have on HIMSS, but I'm going to be adding to my other tickers. I don't plan on adding anything to HIMSS until next quarter, most likely, because like I said, I don't like that free cash flow is negative. We're at a 6-ish billion market cap. Revenue growth is cool, but I don't care until I start seeing the money actually start hitting bottom line. And I have plenty of exposure. I have enough risk, in my opinion. I mean, it clearly shows that they grow pretty fast. The only bad thing is that the EBITDA isn't catching up, and that's because the big investments they did to grow. Yeah, exactly. You just said it. So, like I said, I have a bunch in it already. I'm comfortable with it. I'm going to just keep looking to add in other places that I can. And honestly, I'll probably just keep adding SoFi. Zeta started to move. I've been in SoFi for like a long time, like 2023 in December. So I know SoFi like the back of my hand, and it's just one of those companies where it's like, I don't know what to add. I'm just gonna add that one because I'm comfortable with management and they just compound. Can you change your mic? Is the mic messing up again? Someone let me know if the mic's messing up again. They could stop expanding and then the profile would catch up, but Hims wants to grow now and to make profits later. People would be upset if Hims wouldn't grow in revenue right now. I would say that people wouldn't necessarily be upset because of the rate they're growing at. Like, that they've always shown to put their foot completely on the gas to the point they were growing at like 111% at one point, and they're already looking to accelerate it to 50% by end of year. So I wouldn't say that people would be mad. Like, I think people would be happy if they would chill and do like a 35% compounding, but they see an opportunity, and I also think in the past they saw a window that was closing, was compounded, so it made sense. Now I think you could do it slower, but you also don't want to let the competition catch up, and I think that is their biggest worry. So they want to keep building out the infrastructure to put pressure on these other telehealth companies who don't own the infrastructure, is my guess. Okay, thank you. Thank you for letting me know about the mic. Alright, sorry. Next time I'm gonna get one of those, I used to have like a muffler thing on it, and then this thing was supposed to take care of it, but I have the, I forget what it's called. It's like the water pump thing. But yeah. Any other questions we got before we get out of here? But overall, my thoughts are, they're investing heavily. The story's gonna take time to play out, so we have to be patient. That's exactly what I'm gonna do. I'm gonna sell my shares. I'm gonna sell covered calls. If it runs for me, it ran before I knew, and I'm young. I'll keep growing. Yeah, this is a basement. Yeah, pop filter. But this is also called a pop filter, but I want the one that actually goes around the mic because it'll get rid of the outside, and I should also be able to go through the filters again. It was supposed to block out this noise, and when my stream was failing earlier because my dog unplugged the mic, I messed with the settings, and I think I changed the filter to block it out. One question I have for management, other than that, small wells buy, why are none of them buying? So I would say from at least the Dudum thing. Dudum, I've made a post on this in the past. Maybe it's time to do it again. But it is estimated that his net worth is 80% in stock, and then, which is around about how much Noto owns of SoFi. It's also estimated like the same range. They estimate the same range for the two, and the difference is, but then we praise his buys even though he owns about the same percentage. But the difference is a guy like Noto, for example, or the CEO of Oscar, his name's like Mark something. Those guys had careers before they became CEOs of these companies. I don't remember the exact company that Mark Guy was a CEO of before Oscar, but for Noto, for example, he was like a CFO of Twitter, and then he also worked high up in the NFL, so he's sitting on money. Andrew Dudum, this is, like I said, when I started investing in this company, he was 35. This is his first, like, real, he was just always in entrepreneurship. This is like his first real job. So, like, that, like, took off. So he's not just sitting on money. Like, he has his salary, and then he has his stock-based compensation, and he probably structured it to have as much stock as he wanted. And when the stock got up to 60, he's like, okay, he probably, because it was a triggered sale too. So I'm sure he had it set that the trigger sale, whenever the stock spiked up to make his net worth a certain percent of, his whole wealth, that it would trim some. And that's probably what happened. Because it was a triggered sell, and I remembered him saying that the stock triggered based off how fast the stock went up at once or something. Which I'm just saying that even like I wouldn't have done the tweet. Like I don't even want to talk about the tweet right now. That's like such old news. But I wouldn't have done the tweet. But no matter what, I think that sale would have happened. And Yemi, I think I looked up his salary. For living in California, his salary doesn't cover that much. So let me see if I can find his salary right now, actually. I want to say 300K, but I don't think that's right. But you also got to think the guy lives in California, where nothing's affordable. Let's see. Yeah, so his salary is estimated to be $495,000 in California. Like, he doesn't make that much money. So I believe these people have right to sell stock. Now, he was rumored to have sold like a bunch of stock, but he had only actually executed a small amount of it. So there's just narratives with selling stocks that people are going to get carried away with, and just like the reality of it is Hims leans heavily into giving their employees or their executive staff a lot of stock-based compensation. And when you don't have much salary, it just leads to you selling. Now, Wells, on the other hand, he was successful and he was with Netflix. He's probably sitting on capital, and that's probably what led to him buying. I mean, he clearly makes enough capital where he can just join the board. So yeah, that's kind of my opinion on it all. But that being said, I'm gonna go ahead and end the stream. I thank you guys for tuning in. I'm going to, do further figuring out with the mic how I can get that noise to quiet down a little bit. I thank you guys for actually bringing these things to my attention. I don't want you guys to think I take it any sort of way. I actually appreciate you guys telling me, because I want to improve it in the future. So I'm gonna do that. And for anyone who didn't hear earlier, we're gonna be doing more live streams. We're going to be doing daily live streams in which Sunday I have a big guest. He's big on Twitter. We're talking about six-figure following. So I know a lot of you guys probably follow him too. He'll be doing TA Sundays with us. We're going to do other days where we do stock tanks, in which I'm going to have someone from Twitter come on and pitch a stock to everybody. So, and then we're going to have other days. I'm going to have a normal show with a friend of mine who's going to, come on every week, and we're just going to talk about the market. So we'll have a specialized day for every day of the week. So look forward to bringing that to you guys, and I hope you guys